IFRS 5, non-current assets held for sale and discontinued operation. This is one standard. I refer to it as inventory. So it has basically almost the same principle as IS2. We'll look at it. IFRS 5 set out the requirements that specify the accounting treatment for assets held for sale in the presentation and disclosure of discontinued operations. IFRS 5 requires assets to meet the criteria to be classified as what held for sale. And we are looking at what measured at what lower of what carrying amount, because this is an asset we are using. When we are using, we'll be depreciating it. So the cost less depreciation is called carrying amount. You get it? Let me just give you a background before we continue. So non-current asset held for sale, it simply refers to the asset we are using as a business. And now we don't want to use them again. We just want to sell it. Now we don't want to add it to our inventories. That would look like IS2. Okay. So we want to sell it all, but we are not, even though we also sell inventory IS2, we don't want to add it to it so that it looks like IS2. So we have a separate standard for it, and that is called what? The IFRS 5. Now we want to sell off those assets that were once in use and being depreciated. And I said cost of an asset less depreciation is what? Is the carrying amount. Okay. So we are going to measure it to the lower of what? The carrying amount and fair value less cost to sell. And we said fair value less cost to sell is what? NRV, net realizable value. That's why I told you guys to take note of it. You meet it throughout. Fair value less cost to sell. So it's basically like IS2, lower of what? Cost and net realizable value. So this is also lower of what? Carrying amount and what? Fair value less cost to sell. Carrying amount and net realizable value. Now, when an asset is classified as held for sale, when we don't want to use the asset and we now want to dispose the asset off, okay, we don't depreciate them. Or let me say, when it's now classified, there are some conditions that needs to be met. And when the conditions are met and we now classify it as held for sale, we don't depreciate them. Then three, we are presented separately on the face of the financial statement. So you don't go and hide it. That's why I said we don't add it to our inventories in our balance sheet. It will look like IS2. Okay, so we present it separately on the face of the financial statement so that anyone who sees it knows that, oh, okay, financing consult has an asset, maybe table, laptop that they were using, and now they want to dispose them off. Okay, so additionally, the results from discontinued operation. So discontinued operation is like you having a product line or a segment, okay, and you are shutting it down. You are not closing the entire business. So example, maybe you produce soap, drink, and maybe you just want to discontinue or close down the soap uh, operations. Let me say that. The soap operations, right? So this standard covers that. So non-current assets held for sale and also what? Your discontinued operations. IFRS 5 identifies three classes of items that might be described as held for sale. These classes are of an increasing level of sophistication. So we are looking at non-current assets, disposal group, and discontinued operation. Now let's go into it. Okay, so definition. So IFRS 5, non-current assets held for sale and discontinued operation outlines how to account for non-current assets held for sale or for distribution to owners. So maybe we don't want to sell it, we want to distribute the asset to the owners of the business. Right? In general terms, assets or disposal group, we will look at disposal. Held for sale are not depreciated. So once again, the moment the assets meet the condition or the criteria are met, and we classify them as held for sale, we don't depreciate them, even though they are depreciable assets. Okay. And are measured at lower of what carrying amount and fair value less cost to sell. That's our net realizable value. And are presented separately in the statement of financial position. Specific disclosures are also required for discontinued operation and disposal of non-current assets. A non-current asset or disposal group should be classified. So it should be classified in the balance sheet as what? Held for sale. So this is the name you would see in the balance sheet. So you either see held for sale or you see disposal group. This carrying amount can be recovered principally through a sale transaction rather than from continuing use. Relevant terminologies. So I think we've spoken about this already. Let's look at disposal group and let's continue. So it's a group of assets to be disposed of, as I have said, by sale or otherwise, together as a group in a single transaction, and liabilities directly associated with those assets that will be transferred in the transactions. The group includes goodwill acquired in a business combination. Okay. So in general, the following conditions must be met for an asset or a disposal group to be classified as held for sale. So one, management is committed to the plan of sale. Okay, management should be committed to the plan to sell the asset. Two, the asset is available for immediate sale. So don't say, oh, the asset is somewhere, we have to go and bring it, go and fix it, go and patch somewhere, repair, upgrade. No, then it doesn't meet the criteria. As at the time, the asset should be available. Three, an active program to locate a buyer is initiated. So management should not sit in their offices and just say, oh, we want to sell this asset, so let's classify it as held for sale. There should be an action from management trying to get someone to buy the asset. Then four, the sale is highly probable within 12 months. So highly probable means within 12 months of classifying the asset as held for sale. Like all things being equal, within the next 12 months or within the next financial year, we should be able to dispose of the asset. Then this is the most important one. That one I don't know, but it's so dear to my heart. The asset is being actively marketed for sale at a price reasonable in relation to the fair value of the asset. So let me give you the whole trick. We said assets that are classified under IFRS 5 are not depreciated. You know, anytime you depreciate your assets, the value of the asset goes down. Okay. So sometimes management would like to play some tricks. They would intentionally classify the assets as held for sale so that they will not depreciate their assets. Okay. And if they don't depreciate it, their balance sheet will look nice, huge figures. And you know, sometimes when it comes to business valuation, they use the balance sheet method. So if they are to use the balance sheet method, it means the business is valued at like high value. Okay. The business is being valued very high. So they would intentionally push some of the assets under IFRS 5. They will classify it as held for sale. But ideally, their intentions is not to sell the asset, but just to take advantage of the fact that it's not going to be depreciated. That's why they came up with this condition. That one, management should be committed. So it's not as if today management will say let's sell it, then tomorrow they will come that, oh, we've changed our mind. They should be committed to the plan to sell the asset. Two, the asset should be available. You know, sometimes they will tell you, oh, we are selling it, but you have to give us some 2 months, 3 months to go and uplift it or go and repair. No, 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 no. As at the time that we are classifying as held for sale, the asset should be available for immediate sale. Then three, there should be an active program. Management can intentionally classify it as held for sale, and no one is aware. As an auditor, when you go, tell, oh, we are selling it, but who is aware? No one is aware. In fact, sometimes some staff are not even aware that they are selling some of their assets. So you could know that, oh, this is a scheme, right? So there should be an active program. You see some organizations publishing it on the newspaper and all those things, that we are owning our assets and all those things, right? Uh-huh. Then the sale should be highly probable. So all thing, all things being equal, our anticipation is that by the end of the next financial period, we should be able to what? To dispose of the assets. Then we are saying that the price at which management is selling the thing should be reasonable. Sometimes in order to discourage people from coming to buy the assets, if the fair value of the asset is 5,000, they can say, oh, we are selling it for 200,000. So indirectly, management is not saying, say, we will not sell it, oh, but they are not selling it. They will not use their mouth to tell you that we will not sell it. But by the price that they are quoting, they are just discouraging people from coming to buy. So the asset needs to be disposed of through what? Through sale. Therefore, operations that are expected to wind down will be expected to abandon will not meet the definition. Okay. But may be classified as what? Discontinued operation once abandoned. An entity that is committed to a sale involving loss of control of a subsidiary that qualifies for held for sale classification under IFRS 5 classifies all of the assets and liability of that subsidiary as held for sale, even if the entity will retain a non-controlling. This is also another terminology you will get to familiarize yourself when we are looking at console, non-controlling interest in its former subsidiary after the sale. So basically, we are saying that even if we are disposing of a subsidiary, we will just what? Classify it as held for sale and all the assets and liability. In fact, that's what even happens if you are selling a company. Okay, it goes beyond giving them the registration document. You are selling all the assets and the liabilities of the company to the new owner. That is why the standard, they try their possible best to force accountant to disclose all those information, including what we read under IS2, that even if you have used the inventory as securities for some loans or liability, disclose it. Because if the person buys it, the person has bought the liability as well. If the person buys the company, the person has bought the liabilities as well. So the person should be aware of what he or she is buying before someone sues. So held for distribution to owners. Okay. So this classification. The classification, presentation, and measurement requirement of IFRS 5 also applies to non-current assets or disposal group that is classified as what? Held for sale to owners. I mostly like to write this. So this IFRS 5 paragraph 5 and this paragraph 12. I mostly like to do some referencing. Okay. The entity must be committed to the distribution. If they say they want to distribute the asset to the owners, the asset must be available for what? Immediate distribution. And the distribution must be what? Highly probable. Okay, so it's just like the other conditions. Disposal group, we've talked about disposal group. Now let's talk about measurement. Measurement. So after classification as held for sale, non-current assets or disposal group that are classified as held for sale, oh, okay, are measured at what? Lower of carrying amount and fair value, less what? Cost to sell. So carrying amount. Oh, so people are in the waiting room. So let me just use symbols. Permit me to use symbols. Lower, this is the symbol for lower, okay? Lower of carrying amount and what? Net realizable value. If the carrying amount exceeds fair value less cost to sell, so if the carrying amount exceeds NRV, the asset must be written down to its what? Fair value less cost to sell. If the carrying amount exceeds the NRV, then it should be written down to what? NRV. The difference, which is amount of the write down, is treated as what? Impairment loss, and it should be recognized in your what? In your P&L. Once again, I said we will look at impairment at what? IS 36. IS 36 talks about impairment. But basically, impairment talks about your carrying amount being more than your net realizable value. Your carrying amount, your cost, okay, less accumulated depreciation. If it is more than your recoverable amount, and your recoverable amount will be higher of net realizable value and value in use. But now, because you are not looking into IAS 36 deep, let's assume our recoverable amount is our net realizable value. So if our carrying amount is higher than this, our net realizable value, we would write it down to net realizable value, and the difference will be treated as what? As an expense in our P&L. Assets carried at fair value prior to initial classification. So for such assets, the requirement is to deduct cost to sell from what? Fair value, and may result in an immediate charge to what? To profit or loss. So when we look at IAS 16, in measuring the asset, okay, we can either go with cost or we can go with the fair value model. Okay, so what we've been talking about so far has to do with the cost, where we deduct our depreciation. But in the case where we are doing the fair value model, the standard is saying we should just deduct our cost to sell from it. Subsequent increase in fair value. So again, for any subsequent increase in fair value less cost to sell of an asset can be recognized in the profit or loss to the extent that it is not in excess of the cumulative impairment that has been charged in accordance with IFRS 5 or previously in accordance with IAS 36. I know it will still refer as to IAS 36. So then last one, no depreciation. So non-current assets or disposal group that are classified as held for sale are not depreciated. Paragraph 25 of IFRS 5. Presentation. So how this should be presented in the financial statement. We talked about how it should be measured. Okay. Then how it should be presented. So assets classified as held for sale and the assets and liabilities included within a disposal group must be presented separately on the face of the financial statement. Okay, so changes to a plan of sale. So if a sale does not take place within 1 year, remember we said 12 months, it should be highly probable, so you're looking at 12 months. So you're saying that if it doesn't happen within 1 year, an asset or a disposal group can still be classified as held for sale. And here are the two things. If the delay has been caused by event or circumstance beyond the entity's control, sometimes you could see that management have tried their best. They've done whatever they can do, but they didn't get a buyer. Okay, the price too is reasonable. Just that they didn't get anyone to come and buy. And two, there is sufficient evidence that management is still committed to the sale. Management is still committed to the sale. And they were not able to sell their assets based on circumstances beyond their reach. Maybe they wanted to dispose of their office and COVID came. Those companies that they were even having offices told their people to work from home. You get it? So then there was no need for the office again. So COVID is beyond the company's reach, beyond the company's control. It's a global thing. Okay. So if that is the case, then management can still go ahead and classify the asset as what? Held for sale. But if it's something within their reach, then we will just say that, oh, they are intentionally doing that to manipulate the thing. But this one, you can clearly say that, oh, it is outside their control. If the criteria for held for sale are no longer met, so all those criteria we listed, then the entity must cease to classify the asset or disposal group as held for sale. The asset or disposal group must be measured at its lower of the carrying amount. See this, before it was classified as held for sale. The carrying amount before it was classified as held for sale, adjusted for any depreciation, amortization, or revaluation that would have been recognized hadn't not been the classification of what held for sale. We said anytime an asset is classified as held for sale, we do not depreciate it. So if you go and classify as held for sale, and later you come back and tell us that, Charlie, me have changed my mind, I will not sell it again, then we will tell you that, okay, that's cool. But we will pick the carrying amount before we classify that as held for sale, and we will charge depreciation. We will make the necessary adjustment as if we never even classified as held for sale in the first place. So all the net relevant depreciation will be computed and will be hit against the carrying amount. Then two, recoverable amount as at the date of what the subsequent decision not to sell. Any adjustment required is recognized in profit or loss as what? Either gains or losses from continuing operations. So recoverable amount. Recoverable amount is also under IAS 36 impairment. So, but that's higher of NRV and value in use. Higher of it. Okay. So presentation in the balance sheet. So IFRS 5 states that assets classified as held for sale should be presented separately. We've talked about that. But let's look at this. Assets and liabilities held for sale should not offset and presented as a single amount. So it is possible that this same asset that we are classifying as held for sale, we may have some liabilities being associated with the assets. Example, I bought the asset from Meshach. Okay. So Meshach said the asset is 5,000 and I've paid 3,000. So I have a liabilities of 2,000 in my books, right? And now I also want to sell the assets and I now have the value. Let's say when we agree the fair value of the asset is now 7,000. Let's just say 7,000. The standard is saying that I shouldn't take off the 2,000 liability from the 7,000 and recognize 5,000. I should treat the assets separately and I should also treat the liabilities separately. So the major classes of assets and liabilities classified as held for sale must be separately disclosed either on the face of the financial statement or in the note. So yeah, so we can just have disposal group on the face of the balance sheet or statement of financial position. Then when you go to the note, you give a detailed breakdown that, oh, our disposal group is made up of laptop, let me say computer and accessories, furniture, office equipment. You kind of give the breakdown. Okay. You give the breakdown. Like different classes that makes up the disposal group. Where an asset or disposal group is classified as held for sale after reporting date, but before the issue of the financial statement, details should be disclosed in the note. This is a non-adjusted event. So we are also looking at another standard. So you are seeing standards in standards. FIC is preparing its financial statements for the year ended 31st December 2014 and has already found a potential buyer. On 31st December 2014, a survey was carried out and it was discovered that the building had dry roots and substantial remedial work would be necessary. The buyer is prepared to wait for the work to be carried out, but the property will not be sold until the problem has been rectified. This is not expected to occur until summer 2015. Can the property be classified as held for sale?